this video, we're going to begin to look at cash flow forecasts. Now, cash flow is incredibly important for all businesses, and we'll examine exactly what cash flow is. But cash flow can be hard to predict, particularly for small and new businesses. Being able to produce an accurate cash flow forecast is an essential skill for the entrepreneur, so that they can predict how much money the business expects to receive and pay out over a given period of time. Now, a cash flow forecast is just that. It's a forecast, or a prediction, of the money that's expected to go in and out of the business's bank account before these things actually happen in reality. Now, a cash flow statement, importantly, is different to a cash flow forecast, as a cash flow statement shows the actual cash flows for the business after all of this has actually happened. So cash flow problems are one of the main reasons that businesses fail, but producing regular and reliable cash flow forecasting can help give businesses advance warnings of any cash shortages that might be coming up, so that they can come up with a plan. It's important to remember that cash flow is not the same as profit. Profit looks at sales revenue minus costs, while cash flow shows how much money is going into and out of a business at a particular time. Imagine you own a timber company that supplies wood to local businesses. You may have sold some of this wood to these businesses, but you might give them time to pay their bill. So in theory, you have sold the wood for a profit, but until you have the actual cash in your bank, you can't really use it, can you? To all the teachers out there, show all of these videos without any ads and gain access to our growing library of over 500 teaching worksheets. Why not visit BizzWizard.co.uk to find out more? So let's start by looking at what we mean by a cash flow forecast and some of the key terms that we use. We'll then look at how to put together a cash flow forecast for a specific business. So a cash flow forecast is a way of estimating how much money is going to come into the business and how much money is going to go out of the business in a certain period of time. Money coming into the business is known as a cash inflow. It's flowing into the business. And money going out of the business is known as a cash outflow. Money flowing out of the business. So let's have a look at some examples, firstly, of cash inflows. So, cash from sales of products and services sold to customers is a key cash inflow, and it's one of the main reasons that most businesses exist. And this is one of the most sustainable sources of cash inflow. If you've got sales revenue coming in, it's a sign of a successful business. So the business may also be owed money from debtors, usually sales that have been made on credit terms. So if they've given customers 30 days to pay their invoices, this will be another cash inflow when the invoice is eventually paid. Now, when they put their money in their business bank account, that might pay interest. And if that's the case, then they may earn interest on this bank balance, which would be another type of cash inflow. Again, capital from investors is another key cash inflow. Whether this is from the business owner or from the sale of equity shares to shareholders in a company, this would still be an inflow. And then we've got external finance, which is a common form of cash inflow to a business, especially things like bank loans or business grants. Although most business grants don't need to be repaid, as we have discussed in previous videos, it's important to be aware that loans do need to be repaid, and they almost always have interest added, which will actually be a cash outflow later down the line. You've got to remember that borrowings are not really a sustainable form of cash inflow in the long run. A business can't just keep borrowing forever. Eventually this is going to catch up with them. So they need other cash inflows. Another type of cash inflow that they could consider is selling fixed assets, such as machinery or equipment that is no longer needed by the business, and this can instead be used for increasing that cash inflow, that money flowing into the business. And if your business has a spare office or warehouse space that isn't being used, then it can increase its cash inflows by renting this out to another smaller business. So basically, as you can see, the total inflow, well, this refers to all the money that has come into the business by adding up all of these different cash inflows. So now that we understand cash inflow, money flowing into the business, let's have a look at some examples of cash outflows that a business might have. One of the biggest and the most important cash outflows for a business is paying their staff wages. To be able to sell products or provide services, most businesses will need to buy materials or stock from their suppliers. And this material purchase will be a cash outflow. If they have staff and they have stock, then a business will usually need premises as a place for their staff to work and to sell their products or provide their services. And this means that rent or mortgage payments are another common cash outflow, money flowing out of the business. And they will always need to pay utility bills, such as electricity, water and gas, along with insurance and IT costs. They might also have to spend money on fixed assets, such as machinery or equipment that they need to be able to provide their services or create their products. And there are many other potential cash outflows, such as the repayment of interest paid on loans and overdrafts. Some businesses will pay dividend payments to their shareholders, and most businesses will have to pay taxes to the HMRC. And these are all cash outflows. So when we say total outflow, well, this refers to all of the money that has gone out of the business that month or in the specific period. And it is calculated by adding together all of these different cash outflows. So as you can see, all of these cash outflows, well, they quickly add up. So it's vitally important that we keep a close eye on them. Okay, so now that we've covered cash inflow and cash outflow, a very important term that you need to remember when conducting a cash flow forecast is net cash flow. And this is the difference between all of the cash that's flowing in, all the inflows, and all of the cash that's flowing out, all of the outflows. And this net cash flow determines whether the bank balance will increase or decrease at the end of the specific period, usually at the end of the month. So if the business's cash inflows are greater than the cash outflows, then they're going to have a positive net cash flow, and their bank balance will increase. And this is good for the business, because this means that they are forecasting that they will have more money coming in than they need to pay out. However, if their cash inflows are lower than their cash outflows, then they're going to have a negative cash flow and their bank balance will decrease. And this means that they're predicting that they will pay out more money than they're going to receive in. And if the business has long periods of negative cash flow, well, this might lead to financial difficulty and even complete failure. And finally, let's look at what we mean by opening balance and closing balance. It's a really important concept that you need to understand here. So the opening balance is the amount of money that the business has in the bank balance, at the start of the period, which is usually month by month. And the closing balance is the actual cash that the business is left with at the end of that particular period. And it's calculated by adding the net cash flow to the opening balance. So if the net cash flow is negative, it is deducted from the opening balance. And this should make sense. If your opening balance at the beginning of a month is £100 and you have a net cash flow of £50, then at the end of that month, you have £150. If you have an opening balance of £100 and you lose £50, you spend £50 and make no money, then your closing balance is only going to be £50. £100 minus that £50. Okay, you also need to understand that the closing balance for one period, well, that becomes the opening balance for the next period. You really can't misunderstand this, If you finish the day on the 31st of January with £10, well, that's your closing balance for this month. And the next day, on the 1st of February, your opening balance is that same £10. Now, using a cash flow forecast will predict a balance for the end of each period, and as I've said, each of these periods is usually broken down on a monthly basis, and it's normally shown as a table like this one. So let's work through a very simple example of a cash flow forecast before we meet our main character for this video. Let's assume that we have a brand new business that starts trading in January, and we want to forecast its cash flow for the first 4 months of the year. We'll assume that it starts off with no money in the bank account. The business owner is forecasting total cash inflows of £1,000 each month. And they're also forecasting total cash outflows of £600 a month. So let's start by putting these figures into our cash flow table. So now let's work out the net cash flow forecast for each of these months. And this is done by subtracting the cash outflows from the cash inflows and then adding them into the required row on the table. So we know that the closing balance, well, that equals the opening balance plus that net cash flow. So we can now work out the closing balance for January and we can add it into the table. The closing balance for January will be the opening balance for February, so we can add that into the table. And then we can repeat this process by adding on the net cash flow to the opening balance for each of the months. We can see that the closing balance is forecast to increase to £1,600 by the end of April. And this is a really basic example, but it should give you a general idea of what's going on here. Now, to help us improve our understanding, we will need to apply our learning to this video's main example. This is Sakura Tanaka, who is an interior designer and has just started her own interior design business called Mindful Interiors. Sakura doesn't have much business knowledge, and she's been supported by her family to get her business off the ground. She's been asked to put together a cash flow forecast for the next 4 months by her bank, and she's come up with some estimates of all the figures that she's going to need to pull together. So let's start with Sakura's forecasted cash inflows. Her parents are going to lend Sakura £10,000 to start up her business, which they will give her in January. They have told her that she can start repaying the loan in 12 months' time, so there won't be any loan repayments in this particular cash flow forecast. And this loan from her parents, well, that's classed as an inflow. So she adds this under receipts, which is another word for sales revenue. And she is forecasting to make sales of £1,000 in January, £2,000 in February, £3,000 in March, and £4,000 in April. And all of her customers are going to pay her straight away. So she adds each value to the sales row for each month. Sakura then adds all of the outflows that she plans to spend on buying equipment, materials, her own wages, the broadband, the IT and travel costs, and she adds all of this into her cash flow forecast table. She predicts that she will only purchase equipment of £5,000 in the first month, in January. She also predicts that she will spend less, she will have less outflows on materials as the months go on, but that her travel costs are actually likely to increase. And always remember that this is just a forecast. It's based on predictions, and you will usually always be given these values in any exam question. So, with all of this information in the table, she then adds up all of the cash inflows to get a total cash inflow for each month. And she adds up all of the outflows to get a total cash outflow for each month, and she completes the table accordingly. Sakura then subtracts her total cash outflows from her total cash inflows to get a net cash flow figure for each month. and she then adds these values to her table as well. So you'll see that in February, Sakura's cash inflows of £2,000 are actually lower than her cash outflows of £3,500, and this means that she has a negative net cash flow. This figure is shown in brackets to show that it's a negative number, and this is important to make a note of. We don't use a minus sign in these tables, but instead we show a negative surrounded by these brackets. Bring this video and over 100 more to life with fun, interactive games, quizzes and case studies. Why not try the first 25 completely free by visiting BizzWizard.co.uk. So as a new business, Sakura had zero money in her bank account until her parents lent her the £10,000 in January. So her opening balance for January is £0. And now that Sakura has her opening balance and she has her net cash flow for January, she can work out her forecasted closing balance for January by adding them together. Remember, closing balance equals opening balance plus net cash flow. So the opening balance was £0, and the net cash flow in this scenario was £1,600. So adding these together makes a closing balance of, £1,600. And as we know, the closing balance for January will also be the opening balance for February. So in February, Sakura has an opening balance of £1,600. Sakura then repeats this for the rest of the months on her cash flow table to get a forecasted closing balance for each of the 4 months, remembering that the closing balance from one month will become the opening balance for the next month. Sakura can see that if her forecast is accurate, she will have just enough money to keep going with the startup loan from her parents. However, she's only forecasting to have £100 in the bank at the end of February, so she'll need to keep a very close eye on things when this time comes. Each of the video courses over at BizzWizard.co.uk also includes an interactive business case study that applies the knowledge learned to a real-world scenario. There are over 1,000 multiple-choice questions, each with detailed feedback, which tests students' understanding of the content. Why not visit BizzWizard.co.uk to find out more? So, there we have it. We've looked at a worked example. But before we wrap up what I know is a rather long topic, let's first have a quick look at the advantages to Sakura's business, Mindful Interiors, of going through this process and producing a cash flow forecast. Well, first of all, it will help Sakura to understand what her predicted cash balances are month by month. She can also see if the £10,000 loan from her parents to start up her business is likely to be enough. If not, she can start planning in advance to see if there are any other potential sources of finance which might be available to her. And she can also see if any months are particularly tight, or maybe even forecast to have a negative closing balance, which could be a big problem. She's already aware that she needs to keep a close eye on things in February in particular, as she's only predicting to have that £100 in the bank. And finally, a cash flow forecast can be really useful for stakeholders in any business. Sakura's bank have asked for this before they will even allow her to open a business bank account. But her parents will also want to see this as they have made a loan to the business, and they will want to check that everything is going to go smoothly. As with everything, there are two sides to this coin, so let's also have a look at the potential disadvantages for Sakura's business. First of all, a forecast is just a forecast. It may not reflect what's actually going to happen. Sakura's sales may be very different from her forecast, or some of her expenditure may be different. Sakura might have rushed her forecast and missed out some important items, but even if she's done it very carefully and she's taken a lot of time over it, it still won't be 100% correct, as it's all based on estimates. And finally, well, there's a danger that Sakura might be lulled into a false sense of security by this forecast, and that she might forget to look at it again for some time. It's really important that she updates her forecast regularly, particularly if she knows that something has changed, and that therefore her forecast needs to change. So as we've seen in this video, cash flow forecasting is a really important tool for a business. Without cash, a business cannot survive. It's important to make sure that you understand the meaning of all the key terms that we've used in this video, and that you can put a cash flow forecast together using information given to you in the exam, just as we did with Sakura's cash flow forecast. So join me in the next video, where we'll look more in detail at the usefulness of a cash flow forecast. But until then, this has been the BizzWizard. See you in the next video.